Good afternoon to everyone. I am discussing very important topics for become fifth semester classes. Course name Fundamentals of Financial Management as per Guwahati University Syllabus. I will discuss the unit 1 from Fundamentals of Financial Management, that is Basics of Financial Management. Myself, Dipanjan Chakraborty, Department of Commerce, Darrang College, Tezpur. I will start with the introduction part first. Finance is an important function in any business as money is required to support its various activities. It has given birth to financial management as a separate subject. That means from finance, financial management has been evolved. As a separate subject, financial management is of recent origin and has not acquired a body of knowledge of its own. It draws heavily on economics for its theoretical concepts. In the early half of last century, the job of financial management was largely confined to the acquisition of funds. Basically, the job of financial management was acquisition of funds. That means how the funds are acquired. But with the passage of time, as the business firm continue to expand, continue to grow their markets, and they become larger and diversified, greater control of financial operations become highly important. Thus, now the scope of financial management is very wide, and it should not be considered to be merely restricted for raising of capital. It also covers other aspects of financing, such as the needs of capital, raising sufficient amount of funds, cost of financing, budgeting, maintaining liquidity, lending and borrowing policies, dividend policy, and so on. Now, very important part of financial management, there is meaning of financial management. What is financial management? What do we mean by financial management? Finance is considered as the lifeblood of any business. It is defined as the provision of money at the time it is needed. All the plans of a businessman would remain mere dreams unless adequate money is available to convert them into reality. Because without finance, no business can run, no business can survive. Finance is utmost necessary for a business to grow, to survive. Financial management is very important to every type of business organizations. It refers to that part of managerial activity which is concerned with the procurement and the utilization of funds for business purpose. That means in financial management, two things are very important. One is procurement of funds and utilization of funds, and that is financial management. In other words, it is concerned with acquiring, financing, and managing assets. Acquiring, financing, and managing assets to accomplish the overall goal of a business enterprise. If a business enterprise want to achieve its goal, want to achieve its main objectives, a business firm or a organizations must acquire finance and manage assets in a proper way. That means mainly maximization of shareholders' wealth is one of the main things of financial management. The different writers have defined financial management in a different way. But in the words of Howard and Upton, financial management involves the application of general management principles to financial operations. That means how the principles of general management, like planning, organization, staffing, directive, quality, applies to financial operations. Thus, financial management is concerned with estimation of fixed and working capital requirements, formulation of capital structures, procurement of fixed and working capital, and management of earnings. That means first and foremost duty of the finance manager is to calculate or determine how much amount of fixed and working capital will be required in organizations. That has to be set first. Then he has to formulate a balanced capital structures. Balanced capital structures may be in the form of proper mixing of debt and equity. The next step is to how to procure fixed capital and working capital from different sources. And the last aspects of financial management is management of earnings. If a firm earns, earning is not only the main things. When a firm has to manage the earnings, a business has to manage the earnings. Whole earnings should not be distributed as dividends. Part of the earnings should be distributed as dividend to the shareholders, and other part should be kept as for the future expansion, growth, and diversification of the business. This is all about the concept of financial management. Then coming to a very important part of financial management, aspects of financial management. In the definition part, we have already dealt that financial management deals with the procurement of fund and utilization of funds. Again, we are discussing this in the form of two basic aspects, that is procurement of funds and effective use of these funds to achieve business objectives. That means to achieve business objectives, a firm has to procure funds, and the effective use of this fund is very, very important. Now, how the funds will be procured? Since funds can be obtained from different sources, therefore their procurement is always considered as a complex problem by business concern. Some of the sources for the funds of business enterprise are, for a firm, for a business, there are different sources of procurement of funds, because the first aspects of financial management is procurement of funds. A firm can issue debentures, a firm can issue bonds by raising their capitals, a firm can issue equity shares by selling equity shares in the market, capital can be raised. A firm can depend on hire purchase and leasing. A firm can take loan from the banks. Loan may be in the form of short-term loan and the long-term loans. A firm can depend on engine financing. A firm can depend on venture capitals. Nowadays, these two concepts, angel financing and venture capitals, are very popular nowadays. There are lots of angel financiers in the markets. They are in the form of entrepreneurs. They are in the form of friends and relatives, etc., etc. These angel financiers invest their own funds in the newly startup or newly business. They fund, they give loan to this newly startup and this newly growth business from their own funds. That means they invest their funds in the startups. In the return, they take some percentage of profits from the firm, because when they invest their own funds in the business to a newly startups, they take something from the business. That is, they take 20 to 30% of equity from the business. Venture capitalists are also there in the market. They are the very risky form of financing. The difference between venture capital and angel financing is that angel financier are invest their own funds they help their own funds to the business, to the firm. But venture capitalists, they first take the money from other institutions or organizations, even from other parties, and after taking loans or taking finance from other parties, then they give these funds or invest their funds in the business or firms. In lieu also, they take some percentage of their profits from the business. So these are the different categories of sources a firm has to depend. Now, out of these sources, let's discuss some of the sources in a very easier way. One of the first sources is equity shares. A firm can procure funds from the equity shares, because equity shares are the best form of financing, because it carries less amount of risks. And there is another characteristic of equity shares is that a firm should not refund capital to the equity shareholders during the lifetime of the company. Only when the company is dissolved or when the company goes into liquidation, then the question of raising, refunding of equity capital is there. So from that point of view, equity shares are one of the best form of financing. Then next is debentures. We have already discussed the next source is debentures or bonds. Debentures as a source of finance are comparatively cheaper than the shares because of their tax advantage. The interest that the company pays on debenture is tax-free. We know that the interest on debenture is a tax-deductible expense. But dividend on shares, equity shares, the company pays, that is taxable. So from the point of view, debenture is cheaper than the equity source of equity. Then funding from banks. Commercial banks also play an important role in funding of the business enterprise. Apart from supporting business in their routine activities, deposits and payments, they play an important role in meeting the long-term and short-term needs of the business enterprise. Banks can help to the farm. Banks can help to the business in a variety of ways by meeting their short-term credit, long-term credit, etc., etc. Then there is very important source of fund nowadays. It is popular. There is international funding. Funding is not limited to domestic market. With the liberalizations and globalizations, a business enterprise options to raise capital from international markets. Besides domestic financing, besides domestic raising capital from domestic markets, a firm may have to depend or sometimes depend on international markets. Foreign direct investments and foreign institutional investors are the two major routes for raising funds. So these are the sources of some of the sources of funds. The next aspects of financial management. First aspect we have discussed, that is the procurement of fund, then effective utilization of fund. Next aspects, because in the definition itself, financial management covers two things. One is procurement of funds, another is effective utilization of funds. Once the fund has been procured, now it is the responsibility of the finance managers to how to use effectively in the organizations, because finance manager is also responsible for effective utilization of funds. He has to point out the situations where the funds are being kept idle or where the funds where proper use of funds is not being made. In some cases, he has to decide that funds should not be used, or in the some cases, he has to decide that funds should be used in a proper way. So some of the aspects of fund utilization are utilization for fixed assets. The funds are to be invested in the manner so that the company can produce at its optimum level without endangering its financial solvency. The finance manager, the role of finance manager is very, very important here. The funds are to be invested in manner in such a way that the company can produce at its optimum level without endangering its financial solvency. All funds should not be used. Company has to see the other side also. Company must be in solvent positions. Company should not be in bankrupt positions. That means assets must be more than its liability every time. Liability should not increase the assets. Otherwise, there may be a dangerous position for the firm. And for this, the finance manager would be required to possess sound knowledge of techniques of capital budgeting. The finance managers would be experts in capital budgeting, because capital budgeting is such a technique of financial management which determine in which assets the fund should be invested, because capital budgeting deals with the planning of investment in fixed assets. Planning of investments in fixed assets, because in planning of investment in fixed assets may be in the form of new machinery installation, replacement of machinery, new plants, new products, research and development, etc., etc. Utilization for working capital. The next, after utilization of funds, the finance manager has to look that funds should be utilized for working capital also. The finance manager must also keep in view that the need for adequate working capital. How much working capital will be needed by organizations? That must be phased out by the financial manager, and ensure that while the firms enjoy an optimum level of working capital, so that they do not keep too much funds blocked in inventories, book trades, and cash. After the collection of funds from various sources, finance manager has to see that funds should not be unnecessarily blocked in current assets. Funds should be properly utilized. Working capital means the capital which is required for day-to-day activities of an organizations. If mathematically you can express, working capital is excess of current assets over current liabilities. So finance manager has to see that unnecessarily funds should not be blocked in current assets like stock, inventories, debtors, cash, etc. So these are the ways the funds can be utilized. Next, we are dealing a very important part of financial management, that is finance functions. Value of a firm will depend on various finance functions or decisions. It can be expressed as V is equal to F, I, F, D. The finance functions are divided into long-term and short-term functions and decisions. There are two types of finance functions. One is long-term finance functions and decisions, and another is short-term finance functions and decisions. Long-term finance functions in the form of investment decision, financing decision, and dividend decision. Investment decision, these decisions are concerned with the decisions about the investment of funds. Funds are to be invested in fixed assets and current assets. The finance manager has to be very proactive in dealing with the investment of funds. Funds are to be invested in fixed assets. How much funds to be invested in fixed assets? How much funds should be invested in current assets? The finance manager must be very careful. Then financing decisions. These decisions relate to acquiring the optimum finance to meet the financial objectives and seeing that fixed and working capital are effectively used. Fixed capital and working capital must be effectively managed and effectively used. The financing decisions are helpful in planning for a balanced capital structures. If a finance manager can well define the finance decisions, then this will help him in planning a balanced capital structure. This balanced capital structure is a combination of proper mixing of debt and equity. And dividend decisions is also there in long-term finance decisions. These decisions led to the determination as to how much and how frequently cash can be paid out of the profits of an organization as income for its owners and shareholders. Dividend decisions led to the how much profits can be distributed as dividend to the shareholders. All profits should not be distributed. Finance manager has to be very careful in dealing the cash that can be paid out of the profits of organizations as income for its owners and shareholders. So finance functions composed of long-term finance functions and also short-term finance functions or decisions. Short-term finance functions in the form of working capital management. This is very crucial for the finance managers. Working capital management. Generally, short-term decisions are reduced to management of current assets and current liabilities. That means a finance manager has to properly manage the current assets and current liability. If he can manage the current assets and current liability, that means working capital management should be theirs. Working capital management, that is management of current assets and current liability in a proper way. So finance function, we have discussed, composed of long-term finance functions and decisions and short-term finance functions and decisions. Next, a very important part of financial management, that is finance functions. Functions of financial management. What are the functions of financial management? Functions of financial management may be in the form of estimation of capital requirements, determination of capital composition, choice of sources of funds, disposal of surplus, management of cash, and financial controls. Finance manager has to first find out or determine the how much capital will be required by an organization to survive or to prosper in the long run, so that this capital, which ultimately increases the earning capacity of the enterprise. That means estimations of capital, how much capital, determination of capital is very, very important in an organization to grow. Then determination of capital compositions. Once the estimation has been made, once how much capital will be required is made, then the finance manager has to decide the capital structure. What type of capital structure will be theirs in a firm? Capital structure may be composed of short-term and long-term debt equity analysis. I've already discussed and told in the previous slides that balanced capital structure should be theirs. That is a combination of debt and equity. Then choice of sources of funds. Another functions of financial management is sources of funds. Sources of funds we have already discussed. For additional sources of funds to be procured, a company has many choices, like company can procure from equity shares, debentures, commercial banks, intentional funding, etc., etc. Then disposal of surplus. This is very, very important for the finance manager. The net profit decision has to be made by finance manager. Net profit decision, whether the net profit should be distributed full to the dividend or it should be kept. Some part it should be kept and some part it should be declared as a dividend. That is one is called the part that is to be kept for the retention and the expansion of growth, the diversification, that is called retention of profits, and the surplus that is distributed as dividend, that is called dividend declaration. So there is a proper balance. There should be a proper balance between dividend declaration and retention of profits. Management of cash. Finance manager has to make decisions with regard to cash management, because cash management is very, very important in functions of financial management. Management of cash is utmost important for a finance manager. Then financial controls. The finance manager has not only to plan. The finance manager has not only to plan, but he has to procure and utilize the funds, but he also exercises control over finances. The finance manager has not only to plan, procure, and utilize the funds, but he has also to exercise control over finances. That is, control over finance is very, very important. Now, how the finance can be controlled? There are some techniques are there in financial management. He can apply the techniques of ratio analysis. Finance manager can apply the techniques of budgeting, etc., etc., for financial control, for control over finances. So these are the functions of financial management. Then very important part of financial management we are coming, there is objectives of financial management. Efficient financial management requires the existence of some objectives or goals, because judgment as to whether or not a financial decision is efficient must be made in the light of some objectives. There are numerous objectives of financial management, but here we are going to discuss the two important objectives of financial management. One is called profit maximization, and another is called wealth maximization. What is profit maximization? Main aim of any kind of economic activity is earning profit. A business concern is also functioning mainly for the purpose of earning profit. Profit is the measuring techniques to understand the business efficiency of the concern. Profit maximization is also traditional and narrow approach, which aims at maximizing the profit of the concern. The ultimate aim of the business concern is earning profit. Hence, it considers always to increase the profitability of the concern. Profit is the parameter of measuring the efficiency of the business concern. So it shows the entire position of the business concern. Hence, profit maximization objectives helps to reduce the risk of the business. Every organization has to run for profits. Every organization has to seek for profit, because profit is a measuring rod for judging the efficiency of the organizations. If an organization has to grow, if an organization has to develop in the futures, he has to earn profits. There is no alternative to profits, because profit can keep the business alive. So financial management, from financial management point of view, profit maximization is also one of the objectives of financial management, because sometimes it helps to reduce the risks of the business. Profit is the sole things of the business. Without profit, no business can prosper, no business can survive, no business can run. But though profit maximization is one of the important objectives of financial management, but it has some limitations also. So we have to discuss some points which are favorable for profit maximization. Why profit maximization is taken as one of the fundamental objectives of financial management, and why profit maximization to be ignored or should be ignored as a financial management objectives. Though there are two objectives of financial management, profit maximization and wealth maximization. Profit maximization should also be the objectives of financial management. It may not be the best, but it should be the objectives of financial management. But why profit maximization should be considered? Because every organization is earning for profits. Profit is the parameter of the business operations. Profit reduces risk of the business concern. Profit is the main source of finance. Profitability meets the social needs also. So these are the points for maximization of profit. These are the points for favorable arguments for profit maximization. Why profit maximization should be considered as one of the best objectives for financial management? Because main aim of any organization is earning profits. Without profits, no one can think of anything, because profit is the main source of finance. If there is a profit, every business can think we can run the business. The business will grow definitely. We can satisfy the shareholders, customers, etc. But there are some unfavorable agreements of profit maximization. If there are too many profits, if the firm earn huge profits and that profits may be kept idle, sometimes profit maximization leads to exploiting workers and consumers. We have seen in different international and national scenario that profit maximization sometimes leads to exploiting workers and consumers also. Sometimes profit leads to exploitation of consumers and customers also in the market. Sometimes profit maximization creates immoral practices such as corrupt practice, unfair trade practice. We have seen in the last decades that some of the leading organizations in India or internationals has gone bankrupt or closure due to some immoral practices practiced by some leading CEO or managers of the organizations. So those organizations which runs only for profits, they sometimes tend to commit some immoral practices such as corrupt practices, sometimes inflate the profit, sometimes inflate the goodwill positions, etc., etc. Profit maximization objective leads to inequalities among the stakeholders such as customers, suppliers, and public shareholders. When a firm, when organizations runs for profits, only main objectives of earning profit, they sometimes neglect the customers, they sometimes neglect the suppliers and public shareholders. They should not. They should treat all customers, suppliers, public shareholders as a whole, but they neglect them. There is inequalities. They show the inequalities among the customers, suppliers, and public shareholders. So these are the arguments against profit maximization. So that's why some drawbacks of profit maximization. Profit maximization does not specify the time of expected returns. No one can specify, no one can say what are the expected returns in the coming years. We all depend only profits, but what will be the return in the coming 10 or 5 years, we cannot say if only adopts the profit maximization policy. Profit maximization does not take into consideration the uncertainty of future earnings. Future is uncertain. No one can predict about the futures. So if we go for the only profit maximization principles, that means the uncertainty of future earnings cannot be taken into account in profit maximizations. Profit maximization does not consider the effect of dividend policy on the market price of shares, because if organization to grow, if organization to run, organization has to depend on profits, no doubts. Organization has to give the dividend to the shareholders, but that dividend has a impact on the market price of shares. But profit maximization does not have any so much policy, so much rules and regulations that it impacts on the market price of shares. Profit maximization does not consider the interest of consumers, worker, and the society. When the organizations goes for the profit maximization, earns for the profits, it does not consider the interest, what the consumers are demanding, what the workers are demanding, what the society is demanding. They do not see. The profit maximization does not differentiate between short-term and long-term profits. So these are the drawbacks of profit maximization. That's why profit maximization may not be sometimes considered as the best objective of the financial management. Next comes to wealth maximization, because there are two objectives of financial management. One is profit maximization, another is wealth maximization. Profit maximization we have already discussed. Now we are discussing the wealth maximization objectives. Before discussing the wealth maximization, first you know what is wealth maximization. What is wealth or value maximization model? Shareholders' wealth are the result of cost benefit analysis adjusted with the timing and risks. That is the time value of money. Because in wealth maximization, time value of money is very, very important. But in profit maximization, time value of money is not considered. So what is wealth? Wealth is equal to present value of benefits minus present value of costs. Wealth is present value of benefits minus present value of cost. It is important that benefits measured by the finance managers are in terms of cash flows. Finance managers should emphasize on cash flow for investment or financing decisions, not on accounting profits. A finance manager should emphasize on cash flow. Cash flow in the sense, when a business invests in a particular projects, now this project must generate some cash flows, and finance manager has to depend on cash flow, not for accounting profits. The shareholders value maximization models holds that primary goal of the firm is to maximize its market value. That means primary goal of the firm is to maximize its market value, and implies that business decisions should seek to increase the net present value of the economic profits of the firm. Business organization has to maximize its market value and increase the net present value of the economic benefits of the firms, NPV, net present value, and maximize the market value. So for measuring and maximizing the shareholders' wealth, and for measuring and maximizing the shareholders' wealth, finance manager should follow cash flow approach, not accounting approach, cost benefit analysis, and application of time value of money. These three things are not considered in profit maximization. But when we talk about the objectives of wealth maximizations or value maximizations, then how a finance manager maximize the shareholders' wealth, because maximizing shareholders' wealth is the core objective of financial management. So for maximizing the shareholders' wealth, finance manager should follow cash flow approach. That means inflows, cash inflows. For projects, whenever a firm has to invest in a project, that project will generate cash flows. So cash flow approach is very important. Cost benefit analysis and application of time value of money. What is the value of rupee 1 today, and the value of rupee 1 what tomorrow will be different? That is the time value of money, and that is considered in wealth maximization. How do we measure the value of wealth of a firm? Though we are discussing the second objectives of financial management, that is wealth maximization or value maximization. Now, how do we measure? How can a firm measure the value or wealth of a firm? Value of a firm is represented by the market price of the company's common stock. What is the market price of the company stock? Equity stocks. That is value. The market price of a company stocks or firm stocks represents the focal judgment of all market participants as to what the value of particular firm is. It takes into present and prospective future earnings per shares. Market value of a firm takes into present and prospective future earnings per share, that is EPS, timing and risks of these earnings, the dividend policy of the firm, and many other factors that bear upon the market price of the stocks. The market price serves as a performance index or report card of the firm's progress. It indicates how well management is doing on behalf of stockholders or stockholders. Value of a firm, if we mathematically express, a value of a firm is equal to number of shares multiplied by the market price of shares, or value of a firm is the value of equity plus value of debt. That means value of a firm is the combination of maximization of value of equity and maximization of value of debt. How far a firm can maximize the value of the wealth of the shareholders. And when a firm going to maximize the value of wealth of shareholders, it takes into account the future earnings per shares, timing of these earnings, and the dividend policy and other factors also. So value of a firm is the number of shares multiplied the market price per shares, or value of equity plus value of debt is equal to value of firm. Now, why wealth maximization works? Why these objectives, second objectives of financial management, that is wealth maximization, works? Though we have another objective, profit maximization, but why wealth maximization works? Before we answer this question, it is important to first understand and know what other goals of a business enterprise may have. Some of the other goals of a business enterprise may follow. The goals of a business enterprise, other goals: achieving a higher growth rate, attaining a larger market shares, gaining leadership in the market in terms of products and technology, promoting employee welfare, increasing customer satisfaction, improving community life, supporting education and research, solving societal problems, etc. These are the other objectives of business organizations. Though the above goals are important, but the primary goal remains to be wealth maximization, as it is critical for the very existence of the business enterprise. If a business wants to survive in the long run, wealth maximization must be there. If this goal is not met, if wealth maximization is not met, if value maximization is not met, public institutions would lose confidence in the enterprise and will not invest further in the growth of the organizations. Public will not invest, institution will not invest in the enterprise if wealth maximization principle is not followed. And if the growth of the organization is restricted, then the other goals like community welfare will not get fulfilled. That means if the wealth maximization is not adopted or value of the firm is not maximized, then the other community goal like employee satisfaction, employee welfare will not get fulfilled. Conflicts in profit versus value maximization principle. There is a conflict between profit maximization and value maximization, which is best, which is better, and which should be adopted as the best objectives of the financial management. In any company, management is the decision-taking authority. Everybody knows that management is decision. Top management is taking the every decisions. As a normal tendency, the management may pursue its own personal goals. Management has a own personal goal, that is only profit maximization. But in an organization where there is significant outside participations, to run a business, to run organizations, there are other parties you have to consider, like shareholders, lendings. We have to think about shareholders, we have to think about lenders, others, customers, creditors, etc. In that case, management may not be able to exclusively pursue its personal goals, that is profit maximization, due to constant supervision of the various stakeholders of the company, employees, creditors, customers, government, etc. Because there are these parties are there in the markets. And if we look only for personal goals, that is profit maximization, that is only on personal criteria. That means other stakeholders, this employee, creditors, customer, governments are there in the markets, are there in the company or the markets. The management may not be able to exclusively pursue its personal goals due to constant supervision of these persons or stakeholders. Every entity associated with the company will evaluate the performance of the management from the fulfillment of its own objectives. Every organization associated with the company will evaluate the performance of the management from the fulfillment of its own objectives, whether the management is fulfill its own objectives or not. So every organization has to evaluate the performance of the management. The survival of the management will be threatened if the objective of any entities remains unfulfilled. The existence of the management will be threatened if the objectives of any entities remain fulfilled. The wealth maximization objective is generally in accord with the interest of various groups. When wealth maximization objective is generally taken and it is accepted, it also to be taken in total with the other groups such as owners, employees, creditors, society, and thus it may be consistent with the management objectives of survival. Then we can think of survival of the management, existence of the management. Conflicts in profit maximization versus wealth maximization principle. Wealth maximization also maximizes the accomplishment of other operating objectives, such as maximizing the sales or size, growth of the market shares, or maximizing the chances of company survival and improving the investors and managers' peace of mind. From throughout the discussion, from objectives, from definition, concept, finance functions, functions of financial management, objectives of financial management, we have come to the last part, that is wealth maximization or profit maximization, which is best. Wealth maximization also maximizes the accomplishment of other objectives, such as maximizing the sales, maximizing the size, growth of market shares, or maximizing the chances of company survival. If a company has to survive, if a company has to improve the investor's peace of mind, if a company has to improve the manager's peace of mind, if a company has to growth in the near futures, if a company has to increase the sales or turnover and size, is wealth maximization principle must be adopted. Owing to limitation, timing, social consideration, etc. in profit maximization, because in profit maximization, time value of money is not considered, societal consideration is not considered, companies how to improving the investors' peace of mind, managers' peace of mind is not considered in profit maximization. In today's real world situation, which is uncertain and multi-period in nature, wealth maximization is a better objective, because profit maximization ignores the time value of money. Profit maximization ignores the uncertainty of futures. Profit maximization ignores the societal values, etc., etc. So where the time period is short and degree of uncertainty is not great, wealth maximization and profit maximization amount to essentially the same. But in as a whole, wealth maximization principle is better. Wealth maximization principle is far, far better than profit maximization principles. Thank you.